Excellent, Mikhail. Lovely to be here and from warm, sunny Sydney, Arvo. Whereabouts are you based?
Right now I'm in Italy, and we were just discussing about how funny it is that I'm just starting the day and you just had a full day of work. So
Yeah,
I will try to take at least time as possible from your side because I think that you're very, very busy and also very tired.
I'm sure. No, lots on the go. Thankfully, good busy.
Yeah. So you want to give us a little bit of introduction of Mighty Partners? What are you guys doing over there?
Yeah, absolutely. So we only recently rebranded to Mighty Partners. We launched the business with the name Fundable, and we launched about 3 years ago, just under 3 years ago, as effectively a short-term bridging solution. So the thesis being that there were a lot of businesses that were looking for short-term capital to bridge towards some form of major event, whether that be an equity raise, an R&D grant, perhaps some large enterprise contracts, and rather than doing an internal con note or safe note or trying to raise a small bridging round, being able to use some form of capital partner to be able to get that short-term capital solution was what we launched, what was Fundable with. We pretty quickly identified that a lot of our best clients were looking for a lot more patience, more growth capital, and so we've recently rebranded with Mighty Partners. We've just raised a new venture debt fund, which enables us to offer really flexible, customized debt funding options to Australian growth businesses. And so it's been, a 3-year journey to where we're at today. We're very proud of what we've achieved to date and looking forward to continuing to support the startup scale-up ecosystem.
No, I think that recently it has been one of the most common trend in the industry, to be honest, because we made a shift basically from a only growth, kind of mindset when funding was only to grow and to raise and to actually acquire new customers and to post even better KPIs every time, to kind of a let's say survival mode for a while, and that kind of shift was also present in the VC industry and also in the debt venture industry, because we saw a lot of startups kind of going to venture debt in order to survive. So you already experienced those kind of things in the Australian ecosystem. So there are multiple startups right now looking for bridge round and looking for resources to stay alive at the moment.
Yeah, so the venture debt ecosystem is certainly in Australia, or at least nascent and underpenetrated, underutilized compared to more mature markets such as the US and Singapore and parts of Europe. And so it's very much in its infancy stage in terms of the number of venture debt providers, the number of venture debt deals being written in Australia, and that's been used for many different use cases. So you touched on the use of funds to be able to bridge towards some other equity raise. That's certainly one of the various use cases. Typically, venture debt's used as a way to be able to grow the business, where I guess the founders, the executive team, investors as well are sensitive to dilution, given that the business is valuable and becoming more valuable over time. And so looking at alternative ways to be able to scale the business and to grow the business without always having to raise equity to be able to scale and to, for value accretive purposes. So the space is nascent. The use of alternatives towards equity is nascent, and there are various ways and reasons as to why founders and executive teams, as well as investors, are suggesting venture debts as a capital source to be able to help businesses to do mighty things.
So, but if I'm correct, I think that you also provide growth capital. So you do basically both at the same time. Which is in your opinion, of course, the main differences there when you are choosing if to invest on a company or not? So, or if to provide capital to a company or not?
Yeah, so we only provide debt capital. So we've got various offerings and a very flexible mandate. We can provide loans up to 3 years. We can provide quantums well within the millions. We've got a really flexible mandate. We can offer things like interest-only periods. Flexibility in terms of the repayments of those facilities in terms of drawdowns. So, we only provide debt capital, though, with a very flexible mandate to being able to support businesses at all various different stages and sizes.
And how do you choose exactly where to invest, or where to provide that kind of capital to a company? So you have that kind of, variables or criteria that those startups need to meet, or what's your kind of process when allowing those kind of debts?
Yeah, so we've got a few absolute minimum criteria to be able to support a business. One is that in the current stage, we require that they're an Australian business, or at least have an Australian entity with some revenues flowing into that entity. That's the first. The second is, depending on the term of the loan, we require a certain amount of recurring revenue per month. At a minimum, that's $50K a month of recurring revenue, and that will vary depending on if it's a 1 year, 2 year, 3 year, or in between loan. And then lastly, we require a certain amount of cash runway in the business, and that will vary depending on the term of the loan. And so I guess that's the absolute requirements that we look at. There's obviously many other things that go into our underwriting process. There's about 30 odd metrics that we look at. I think ultimately what we really need to get comfort around is, will we be paid back? And that's just what debt is. And we try to not overcomplicate things. And I think quite often debt providers do over-engineer the process around drawdown conditions and covenants and certain requirements to be able to be able to qualify for capital. And we really try to simplify that and to make it as founder-friendly as possible, and to really make the process as easy as possible to be able to get capital, as well as the conditions that apply to that facility. The process typically takes no more than kind of 2 weeks.
Oh wow, that's
on average.
Short. That's really short.
Mm.
And what's the average ticket there? So what's the kind of normal capital that you provide?
Yeah, the average ticket size at the moment is around that 500K mark, 550K. I think as at our most recent board paper at 550,000.
Okay, no, that's really interesting. I think that the short timing it's very, very interesting, because usually those kind of things took a lot of time, and they usually run for months before having the cash in hand. And it's very hard for those startups, to survive that amount of time and to stay alive and everything else. And they usually have a very short runway. So having a short timing is crucial there. So let me shift the argument a little bit. I would like to understand a little bit better the, let's say, Asia Pacific market, because I think that the Australian market is one of the, let's say, farthest away from the European one. So we don't get, many things about that kind of industry, mostly in the startup ecosystem. So I would like to know a little bit more about, that kind of ecosystem, and which are the main trends about at the moment.
Yeah, so I guess to start off by saying that the Australian venture scene is growing and growing rapidly. And I wasn't in the space at the time, but if I reflect on the number of venture capital businesses that were in the Australian ecosystem 10 years ago, there'd be only around a handful. So the space is nascent, though it's absolutely growing at a rapid pace. Around, obviously, the venture capital scene are other providers, alternative capital or complementary capital sources towards venture capital, and that's also slowly growing, though absolutely compared to more mature markets such as the US. I think in most departments, I like to think of, Australia typically lags a good 8 to 10 years behind the US in the financial services space, and so we've got a long way to go. If I recall, the current numbers of venture debt deals that were registered or had been, what the data shows is that roughly about 2 to 4% of the venture capital volume that had been originated per year is in venture debts, compared to the States, which is about 16% for the last 5 years on average. So it's about 8 times the size in the States, the adoption of venture debts within the market. And I think that comes down to mostly an educational piece around the space, and perhaps also the perception or status around debt as a use of capital. I think in many scenarios, debt is perceived as that there's certainly a risk attached to the debt profile, and as is with equity, as is with any type of capital source, there's a risk attached to it. But I actually think there's also this unsexiness around debts, and that's just transcended over decades. And I think, the more sophisticated founders and executive teams, as well as investors, are looking at various capital sources, not just debts, but R&D lending, perhaps convertible notes, safe notes, other forms of capital sources to be able to help a business to scale efficiently based on the business at that point in time, really.
Yeah, that's a very interesting concept, to be honest. Having debt for a long period of time has been so as a potential risk, for growth, for the sustainability of the company and everything else. It is a risk, of course, but I would say that it's also a potential, variable that drives the growth of a company. What do you think about that kind of shift between, the kind of venture capital that we had in the last 5, 6, 10 years to a potential mix of venture debt and venture capital in the recent years? Because I saw that kind of trend in Europe very, very frequently in the last year and a half. And I would like to understand, how do you think about it, first of all, and if you saw the same kind of trend in Australia right now?
Yeah, so the trends are certainly growing, and assuming that would be the same in Europe. And ultimately, it really comes down to an awareness and the awareness of the various different benefits and what some of the various characteristics are of all of the various different capital sources available to founders. Equity is very simple. It's money in, equity out, or part of the business out. Debt, as well as other forms of capital sources, there's different characteristics attached to them, and I think it's most important that founders understand what it means for their business, and there's an appropriateness depending on the stage of business. There's many benefits to raising equity, particularly if it comes through strategic investors. Perhaps they can open doors. Maybe the valuation there's this perception that can also bring in new investors. There's many benefits to equity. There's also its considerations. There's benefits towards being able to raise debts, whether that's being able to retain ownership, retain control, but the consideration, there's a repayment, there's a serviceability attached to the debts. So it's really important that particularly the founders that take on those capital sources, they understand the characteristics attached to those.
That's really interesting. I was trying to understand, let's say, the real differences between having that kind of debt and having venture capital. And do you think? Let me ask you this question. Do you think that if you were a startup today, would it be better for you to go for venture debt or venture capital? Because I think that obviously the answer depends case by case, of course, but I think that there's been a strong trajectory of raising only venture capital for a long period of time, and that is kind of changing in today's environment. But I would like to understand if you think that it's better for a startup out there to look for debt from time to time, or only to look for growth, and which are maybe the main variable that you should look at in order to take that decision.
It's an excellent question, and you answered the question, which is it really depends.
Yeah.
There's no depending on the stage of business and the use of capital will influence the appropriateness depending on the capital source that they choose. So in the very early days, equity might be the only source that is available to you. To be able to qualify for venture debts, which is to your question around what are some of the considerations you need to think of, is the business needs to have a certain amount of revenue, demonstrable, recurring, predictable revenues to be able to service the debts, or at least cash flow to be able to service the debts, because it's a cash flow lens. So depending on what stage of business, if it's seed stage or angel seed, series A, B, C, D, or all the way to IPO, depending on what stage business will also influence what capital options are actually available to the business. So the first consideration to think of is what stage of business are you in? And the second consideration is what's the use of funds? Debt doesn't work for businesses that are experimenting or being able to use it for capital that doesn't have a confidence around being able to generate an ROI to be able to service the debts. The key difference between debt and equity is debt has a serviceability attached to it. So you have to make monthly or quarterly or daily, that you have to make some form of repayments to be able to pay back the debt, whereas equity doesn't have a repayment profile attached to it. So understanding not just what stage of business you're in, but also what the use of funds are for will influence whether debt or equity might be the best choice. For a business that knows exactly what each dollar of spend will be able to generate for them, if they know that they can, for each dollar of marketing, they can generate $1.50, or they can hire this sales team or expand into this avenue or build this product, and they know that the enterprise value will grow or their revenues will grow by X amount, and they can comfortably understand how they can service the debt, then debt provides a really attractive option for those businesses to be able to grow, because they can comfortably meet those serviceability payments and know what that ROI is going to be. So I guess circling back to your question, what would you recommend to the startup? It really varies, and it'll vary depending on what stage the business is in and what the use of funds are going to be for. And then there's a third, I guess, consideration, which is what does that capital bring to the business as well, which in the case of equity, sometimes that equity investment can open doors. There can be strategic elements attached to the capital. Is the business looking to get acquired? Are they looking to do a further raise and they want to be able to hold on to its ownership for as long as possible, and then perhaps minimize the overall dilution? There's those considerations as well. So there's no, I guess to summarize, there's no single answer to that question.
Probably, yes.
It really varies there's an appropriateness depending on the stage of business, the use of capital, and what the ultimate, I guess, aspirations are for the business.
Yeah, but that's an interesting concept that you said. So multiple times in the industry, we have been talking about the kind of value that a venture capital can bring to a startups, mostly in the early stage, apart from capital, of course. So I would like to understand in the exact same way, let's say, which is the kind of value that a venture debt can provide to a startup. So we say, like, for example, venture capital can open doors, can open the network, can let speak with potential new customers or expand internationally. But let's try to make the same comparison with venture debt. What can venture debt add apart from, of course, the credit line, the credit facility that you will bring?
Yeah, so it's an excellent question, and again, it will vary depending on the funds. We don't hide behind closed doors. We don't pitch ourselves as a active investor or active funder. We provide capital and we want to partner with the business and support them throughout their growth journey through capital. We make some introductions, though that's not we don't lean in with the value add which many equity providers will provide. What I would say is that we, as a venture debt fund, we position ourselves very much as not a substitute but a complementary to equity. Mm-hmm. And many businesses use us to be able to complement their round whilst minimizing the overall dilution that's attached to that round. So they'll come to us and say, hey Ethan, we've just raised 5 million, we're looking to bolster the round, can you provide another million on top of that? Or perhaps instead of raising 5, they raise 4 and then 1 mil through us, to blend the overall cost of funds and to minimize dilution. So in that case, a business is still going to receive perhaps the strategic value that they would have gotten from the equity investor. They just wouldn't, it just depends on what their equity ownership is and what that dilution looks like, while still being able to, blend the overall cost of funds and have a debt component attached to that.
Cool. No, I think it's reasonable, having that kind of value on top of the venture part or the equity part. But let me change the argument a little bit. So I've been recently talking with a couple of US-based venture capital that recently raised funds, and one of the let's say most frequent topic in those conversations was how hard it was to actually raise a fund in this kind of environment. So I would like to ask you the same question. You recently raised a new fund. How hard it was to close it, and how hard it was to raise it?
Challenging.
Yeah, I can imagine, to be honest.
Yeah, and I guess this is somewhat reflective of the space. So we raised a new venture debt funds. I think that's how I actually initially got in touch. We were in a few of the Australian publications that had shared one of the raises that we had raised equity alongside the fund, and I guess the number that was shared and what was seen as the most topical or interesting, the most interesting elements of raising our raise was actually the equity piece, and that was actually what was taken up by the PR agencies was the equity components, which relative is significantly smaller than the fund itself and took significantly less time to raise than the debt fund. So the irony was that perhaps the easier of the two was the most interesting in the eyes of what they assumed of their user base. And I think that's kind of reflective of the space as well, which is equity has this perceived status around it, and people like to read the news articles and see what the headline equity raise was.
The latest round, the amount,
exactly.
The Series A.
And I think that will change over time. Because ultimately the real winners are those that didn't have to raise equity.
Yes.
They still own most of their business or all of their business. And I think it would make for a very interesting story, and for any of the PR writers that are perhaps going to listen to this, just trying to really showcase and to spotlight some of the founder stories of those that have been able to really scale their business and efficiently without perhaps needing to raise all equity or as much equity as they might otherwise have needed to be able to get to that stage. I guess that's a long-winded response to it. It was challenging, and the current funding environment is challenging, it is challenging for funds to be able to raise funds as well, follow-on funds, whether that be debt or equity, particularly in the current interest rate environment. So, it is similar to startups out there. It's also very challenging for funds as well, even with track record, to be able to raise follow-on funds.
No, that's absolutely true. How long it was the entire process? Because recently I saw timeline between 2.5 years, something like that.
Yeah, our new warehouse facility, yeah, it would be probably 4 months, 3-4 months to close.
Hmm.
Um,
That's
yeah,
actually good.
lots
I
of
mean,
backwards and forwards with term
yeah.
sheets. Um, but yeah, significantly longer than the equity piece, and
Yeah.
it's not easy out there.
Yeah, absolutely, yes. One very interesting concept that you just mentioned is interest rates. So we all know that we are coming from a period of time when liquidity and cash overall was basically free with zero interest rate, or also, for example, negative interest rates. In the last 2 years, let's say, the situation changed a lot when central banks all around the world raised interest rates. And right now, that kind of free money is not real anymore. So right now, I think that we are in a kind of different situation. So we kind of seeing the first banks to trying of cuts, interest rates. I would like to understand you from a venture debt perspective. How those kind of things are going to impact your work, and those kind of things are going to impact also the amount of money that you are able to give to startups, because that kind of industry is highly correlated with interest rates.
It's an excellent question, and absolutely, it's our business, as with any businesses, but certainly to a greater extent, our business is influenced by interest rates. For one, I guess the ability for businesses to be able to, the trade-off with being able to perhaps source bank debt, as well as our own cost of funds, are affected by the change in interest rates and how that influences the overall portfolio of the funds as well. So we're always looking at and trying to read into trends in terms of where we foresee interest rates to move, and trying to hedge as much as we can, really.
So one question that I have here is about the correlation with other markets. So I think that the Australian market is highly correlated with the US one. So one curiosity that I had in mind is you are looking more at what the Australian central banks is doing in terms of interest rate, or you're looking more at the Fed in the US of what they're doing there?
I think everyone's looking at the Fed.
Yeah, probably it's a good answer, that one.
And very closely looking at the election, and trying to follow the US markets, absolutely.
Yeah, no, it's kind of common, in this kind of industry, everyone is looking what the Fed is doing, and then everyone else usually react. Even if right now we had, for example, in Europe, couple of cuts under interest rate perspective that were from one way expected, but not that not that common. So we kind of welcome them very, very gladly, But always happy to see those kind of things. Maybe last question, how do you see future trends in this industry? Taking in consideration everything that we said, both on, interest rates, the change from venture capital to venture debt, and the kind of growth that the Australian market will have and is having right now. So how do you see future trends and the future of the startup ecosystem in Australia?
So I hope that the venture debt space is only going to blossom in Australia, and that will come through both an awareness as well as an education around the various capital options available to founders to be able to grow their business. I think if I was to take a 10-year look into the future, I actually think venture debts, and perhaps not just venture debts, but the use of alternative capital options will also be celebrated. And they're similar to my point earlier. I think there will be a celebration around founders being able to achieve their growth ambitions while still owning most or all of their business. And I think that's going to change. I'm obviously a relatively young founder. I kind of always had the dreams and aspirations of getting into the AFR, and which is one of the biggest Australian publications, and others. And the reality is, most of the time that will involve an equity raise. Very few times in the Australian publications will you see this business has just raised 2.5 mil of debt, able to prolong their equity raise. That's not shiny. It's not as sexy.
Doesn't
and
make
I
the
think that's
headlines, you know.
No, it doesn't make the headlines. And I hope it will change. And certainly my perception's changed as well. Recently, we just met with a business, and the founder, completely bootstrapped, just sold for, north of 50 million, completely bootstrapped, Australian-based business, and that's remarkable, really.
Absolutely, yes.
Somewhat unheard of to be able to get to those sort of levels without diluting it along the way. We've also read articles around, founders selling their business whilst not being able to earn anything after liquidation preferences and dilution and the like. So I think the venture debt space as well as alternative capital options will rarely be utilized. And it's only a matter of time. In more mature markets such as the US, the utilization of particularly venture debt is 8 times the level of Australia at the moment, relative to the overall venture capital investments. And that will change. And that perception around debt, the perception around alternative capital, and the use of capital will change as well.
Yeah, I think that we can only hope to see more headlines like this one, you know, people bootstrapping to success, let's say, or using debt to arrive to those kind of things, instead of having only venture capital headlines.
And I would also add, and just to close, there's certainly many benefits to equity, and there's, again, an appropriateness depending on the stage of business and what the use of funds are for. We had to raise equity, we've had to raise lots of equity, and that's been excellent. Though there's more than one way to construct the capital stack. And what will change with awareness is the understanding and what is most appropriate depending on the stage of business, the use of funds, and what you're looking to achieve. And it won't just be the all equity model. It'll be equity is a fantastic source of capital for this purpose. Venture debt is a fantastic source for this purpose, and vice versa, depending on what that use of capital is for and the stage of business.
I strongly believe that there's no specific case, you know, and not only a one case in this industry. Every single startup is different. Every single, you know, cap table is different. Every single growth trajectory is different. So you need to find your own specific source of capital, and every situation is totally different. Ethan, it was a pleasure to speak with you. It was very, very interesting, and I will love to keep in touch about the Australian market because it's very, very interesting. So thank you again for coming, good luck for everything that you're doing right now.
Thanks, Mikhail. Lovely to meet with you, and hopefully one day in person, or maybe I'll make my way to Italy.
More than happy to do that. Thank you again. Bye.
Cheers.